everyone, welcome back. If you're an equity partner in a law firm, or even an accounting practice, or a professional services business, you know how confusing partner draws and distributions can get, especially when you start to talk to your tax professional. Mix them up and you risk some tax headaches, or maybe even partner disputes, or even some IRS flags. Today, I'm going to break down exactly what a draw and a distribution is, the key differences, some proven bookkeeping strategies, some rules that we have to go by, and some tools that'll keep it simple. By the end of this video, you're going to have a good, clear system to manage the draws and distributions confidently. So draws or distributions. This is something that one of the first things we see when we start to go into a client file is we go into the equity section as we're doing the chart of accounts. And I'd say about maybe 75% of the time they're just not presented properly. So just the basics. So a draw is also called a partner withdrawal. And there's regular payments that you take from your law firm. Usually they're monthly or quarterly as compensation for your work. So think of them as an advance of your share of your future profits. I think if you wrap your brain around that they're an advance on your future share of profits, it's going to help you understand that they're not a paycheck per se, but think of it as that. So whatever profit comes out of the business, that's the money you're taking pieces of that out. They come out of your capital account. So distributions are a little bit different. The payments are from the firm's actual net profit. So if you're taking your distribution at the end of the year, those are payments of net profit. And that's income minus your expenses. That's your net profit, your reserves, and of course your taxes. This usually happens twice a year when you look at the books and you close down half a year or the full year, and the profitability is confirmed. So that is completely done. So a draw would be like you're going to take a monthly stipend or even a biweekly stipend, and you're guessing what your distribution is going to be at the end of the year. And distributions are really the reward of the firm's overall success. So here's some key differences that you really need to know. So the purpose, draws are like a regular pay. They're predictable, they're scheduled. Distributions are a return on your equity investment. So the timing matters. Draws are predictable, they're scheduled. Plenty of firms that just take a certain amount out every month. At the end of the year, you can true that up, where distributions are just that return on equity investment. Timing is important. Distributions are performance based and usually at the year end. So that's what you're going to see more so than the regularity of taking a certain amount every month. Tax treatment, draws are usually not subject to payroll taxes, but you still have to pay self-employment tax on them. As anybody knows, if you look at your tax return, it can usually be a good chunk of change, and that's usually on your full share of income. Distributions will flow through your K1 and they're taxed as your share of the partnership profit. So we could take money out of our firm all year long as a draw, but at the end of the year, you tie it up in a bow with the distributions that flow into the K1. So you have to get this distinction right, and it will help you prevent errors in your capital accounts, and it keeps everyone on the same page. If you think about it, some best bookkeeping practices for draws and distributions is to create a standardized template, the date, the amount, the partner, the equity percentage. Make sure you state that in the chart of accounts as well. So those accounts should be Lynda Artesani equity account, then you'll see my contributions and my distributions. You want to see that on your chart of accounts as a standardization, so each equity partner has that. Keep dedicated draw ledger. So keep that separate and reconcile it all the time. So you want to reconcile the money coming out, obviously, to your bank statement. That's just should be part of your process anyway, and do that every month. And there should be clear rules set in your partnership agreement because partners can have various percentages. Sarah and I happen to be 50-50, but sometimes there's different percentages. I actually put that on the chart of accounts to remind me as I'm doing other people's books who's the majority owner, who owns a certain amount. It just makes sense to do. So that way you've got that on the records. And then you want to have that partnership agreement. If you're working with a bookkeeper, the bookkeeper should have access to that. And then inside of that should have your maximum draw limits and how the approval process goes. Because you can see partnerships can crumble where someone's taking the money out without having a conversation with the other partner. It shouldn't be that way. So for distributions, it should also be in that agreement that you agree on the profit allocation formulas and also for reserve policies up front. Close the books accurately at the end of the year. Make sure both or multiple partners have eyes on it. Everybody's signing off on it, and then allocate the profits and distribute what's left by the percentages that are in the partnership agreement. Hold a partner meeting, review the numbers before any money actually moves. That's important. That should be done every month anyway. The partners should be reviewing financials together monthly. So transparency throughout the year will prevent 80% of the 90% of the partnership conflicts. If everybody's doing this kind of a regular meeting, going over the financials, it just makes sense. There's some tax implication every equity partner should know about. Tax season doesn't have to be stressful. So the one thing with draws is you should be withdrawing money, withholding money, and making sure that your quarterly estimated tax payments are made to cover the income that you're pulling out of the business as you go. And as you know, with the IRS, it has to be done per quarter. So if you take a different amount in the beginning of the year and a different amount in the end of the year, you want to make sure that all ties back. All distributions are reported on your K-1. So track your tax basis carefully. Know your percentage that you pay every year. That will affect how your distributions are taxable or not. Many partners will qualify for the Section 199A qualified business income deduction. So work with your CPA, someone who understands professional partnerships. Get a good tax person to help you and give them the documentation. So that's your best defense on any audit. So what are some tools or even some common mistakes to avoid? Obviously, QuickBooks Advanced or Zero, those are great tools for the general ledger, the whole part of the business. Everything in the business flows through that. And then cloud access, so everybody can see the reports at all times. And I've worked with firms that have had multiple partners, and they'll say, "Oh, I don't want Harry to have access to the file, the QuickBooks file, because he'll mess it up." You can still set him up as a user that he can review the reports. He can't really change anything because maybe it happened in the past. They don't want them to have access, but at least give them access so it doesn't look like you're hiding anything, right? And then use the automation features that are inside the products. And as we start to move with AI, you're going to see lots and lots of more automation things that you should use. It should be done so you can keep more accuracy. One of the things you really need to be careful with, and this is something that we see a lot of times with firms and partnerships, everything that belongs to the business should come through the business. No personal, I shouldn't use my personal card or my other business card for the business that's at hand. Every business should have their own set of credit cards. Everything should go through that. There shouldn't be any mucking it up. And yes, accidents can happen when you use the wrong card. It should be reimbursed immediately. It shouldn't wait to the end of the year and then you're trying to figure it out. That just looks bad. The optics looks bad. Don't forget to update the capital accounts. Make sure there's good communication between all partners. That's when problems can happen. So make sure you have good communication between all the partners and try not to rely on spreadsheets. Oh my gosh, we say this over and over again. Spreadsheets just can bring on a world of hurt. One wrong formula and it can throw everything off because the spreadsheet should marry back to the books. But really use the books for this. Make sure you have it all set up that way. So a little technology is going to go a long way. So, strong bookkeeping for your draws and your distributions will protect your firm, reduce stress, and also build trust among the partners. So, your next steps are to review your books, right? We're at the mid-year point already. Can you believe it? We've already passed that. So, review the current partnership agreement and then look at how the draws and distributions are written out. Set up a monthly partner financial review in your firm. Implement proper accounting software. Make sure that if you don't have that in place already, get it going, get it done now. It's a great time to do it. And schedule a check-in with your CPA. Look it over. They get to see not just the business, but they get to see the personal side as well. And that's important to do so that they see big picture, right? Your bookkeeper can be working on the books for the firm, but they don't know what's going on in your personal life. Maybe you got kids going to college. Maybe you're retiring. There's lots of different life events that can happen. Maybe you're going through a divorce. There's lots of things that can happen that can shift and change your path. And it's important to work with your tax professional. And in the middle of the year is a great time. They have more time with you instead of trying to do it when they're up against it with trying to do all the tax returns. So if you found this helpful, please subscribe for more finance and accounting tips for professional firms. Drop a comment below. Are you new to the monthly draws or are you new to the big year-end distributions? I read every comment. So if you have any questions about this, please let me know. This is not tax advice, so know that you need to go to your tax professional. We run bookkeeping firm. We see all these things on a day-to-day basis, but we are not tax professionals. So really discuss it with your tax professional, your business, your personal side. And this is a great time to do it. I hope we'll see you next time, next month for the next video. Bye now.